Hey everyone, I'm Dave from Dave's Market Explorer. Something big is unfolding right now in the bond market, and it's directly impacting the technical setups we've been tracking with our MTF-SRG system. The 30-year Treasury yield has pushed above 5%, hitting levels we haven't seen sustainably since 2007. That's sending ripples through everything, from mortgages to corporate borrowing to equity valuations. Today, I'm breaking down exactly how this yield surge is testing our multi-timeframe rules, why our time targets called for a correction here, and what it means for the months ahead. Stick around, this could be a high-probability setup for the patient trader. First, let's talk yields and our system. Our MTF-SRG rules rely on clear higher timeframe trend alignment combined with lower timeframe confirmation. Rising long-term yields act like gravity on risk assets. They increase borrowing costs, pressure valuations, and often lead to distribution in the markets. When yields break key resistance levels like the recent move above 5%, it creates a shift in the broader market environment that challenges many bullish setups. This is the kind of regime where our system helps us stay disciplined by respecting the higher timeframe signals and avoiding forced trades. Our proprietary time targets have been pointing to a correction window for months. That correction has now arrived. Primary window, June through August. This is where the bulk of the pressure should play out as yields test investor conviction and seasonal factors kick in. Secondary extension, out to October. If we get a deeper grind or retest, this gives the market time to digest the new higher yield reality. The strength of MTF-SRG is that it respects these time cycles instead of fighting them. We're monitoring for signs of exhaustion on the lower timeframes inside these windows to prepare for potential long-side opportunities once the pressure eases. Adding fuel to this setup, we now have the new Federal Reserve Chair in place, Kevin Warsh, sworn in back in May. We anticipated this transition and expected him to face an early test. Exactly what's happening. Warsh is growth-oriented, but with inflation still sticky and yields climbing partly on term premium expansion from debt and policy uncertainty, the bond market is voting with its feet. Investors are demanding higher compensation for long-term risks. This political and policy backdrop increases volatility, perfect for our rules that thrive on clear higher timeframe bias before committing capital. Two more near-term drags to watch. First, supply from IPOs. 2026 is shaping up as a monster year for public debuts. Think OpenAI, SpaceX, Anthropic, Databricks, and others. This flood of new shares can act as a technical overhang, absorbing liquidity and pressuring valuations in tech and growth sectors. Second, oil price overhang. Tom Lee and others have flagged potential pressure later in the year. If energy prices roll over after recent strength, it could ripple into broader risk sentiment and commodities-linked names we track. These aren't reasons to panic, they're setups our MTF-SRG rules are built to navigate. Bottom line, the correction our time targets forecasted is here. Yields are the catalyst, amplified by policy transition, IPO supply, and energy dynamics. For MTF-SRG followers, stay disciplined. Respect the higher timeframe signals. Use these windows for cash management or selective hedging. The system has performed well in similar regimes by avoiding the meat of drawdowns and positioning for the recovery. I'm still constructive longer term. Liquidity, AI tailwinds, and potential Fed pivots remain powerful, but we trade what the market gives us. Drop your thoughts below. Are you seeing the same yield pressure in your charts? Which names are you watching for MTF-SRG entries? If you found this helpful, like, subscribe, and hit the bell. We'll keep updating as the June-August window develops. This is Dave, trade smart, stay process-oriented, and I'll see you in the next one.